Hey everyone, welcome to another episode of Point of More Returns. I am your gracious host, a masked investor, and with me we have the infamous Wealth Bear. Wealth Bear, talk to us, man. What's going on today? What's new?
Hey, what's up, man? Hi, everyone. Thanks for joining. Looking forward to this conversation today.
Yes, indeed. And today's conversation is one that we've been kind of bending about for a while. And, trends have been kind of going a certain way and just thought it'd be good to kind of have a conversation about two things where we're basically doing our normal market update, but we're market update with a twist. So, starting off, I mean, we got two very different people nowadays that are hunting the same businesses right now. One has a fund, they have a deal team, they got a multiple in mind, and the other, they just quit their corporate job because they watched their whole department get laid off, rather through AI or just attrition. And they both want the same HVAC company, but only one of them is going to win. And so let's just start off. So there's a business somewhere in your city right now. It could be a bookkeeping firm, could be a pest control company, could be a plumbing outfit that's been family owned for over 30 years. And the owner's in the late 60s, they're ready to retire, and they just put it up on the market for sale. And here's what's changed, though. The people who show up to buy it don't look like they used to. So it used to be a local entrepreneur, maybe someone who worked in the industry. Now you've got a search fund backed by a private equity firm that's already done 40 acquisitions this year. You've got an MBA who read about entrepreneurship through acquisition and business school elective. And you've got a 41-year-old marketing director who just watched her entire department get restructured due to changes in AI or other priorities. And she's decided she's done betting her future on someone else's company. And so that last one, that's 28% of all buyers in the market right now. Over a quarter of people trying to buy a small business today, they're doing it specifically because they don't trust that their corporate job survives the decade. And so today we're actually getting into who's actually showing up to buy Main Street America and what it means for valuations and whether that little guy even has a shot. And so just to ground you off in some uh, realities, market realities of today, in 2025, total transaction volume was $7.95 billion in the small market. Median sales price hit $350,000, which is an all-time high. So volume essentially was flat compared to 2024. But the quality of the businesses sold is definitely rising because median cash flow is up 3%, turned $58,950. The frame, though, is that this isn't a hot market. It's not a cold market. It's probably what we call a selective market, right? Where a prepared seller wins, everyone else just kind of waits around. And so I guess welfare. I mean, when you hear that, typically flat volume sounds boring. Why would anyone even care about that? Would that be something alarming to you? You just say keep on moving. Is that something you think might be stirring? What's your thoughts on that immediately?
Yeah, thanks for that, man. That's a really good breakdown. Like you're hitting information that I didn't even realize. So 25% of all business buyers are people that are transitioning, looking to get into ETA. Is that right? Did I hear that right?
For the lower middle market, yes, it's 28% of all buyers entering the market in that space are from corporate or,
And then
mhm.
what are the parameters for low to middle market? Is it 5 million? Like 1 million to 5 million? Like what is it?
Yeah, it's less than $25 million.
Less than 25.
Yeah.
Okay.
Hmm.
Okay. Wow. Okay, so I want to try to answer your question at least. So you said the actual volume is down. And when you say
No, the volume is flat compared to 2024. So, it's not, like I said, it's not hot, not cold, just, selective.
sorry,
So it's just
I
flat.
said down. I meant flat.
Yeah.
Yes. Thank you for that. Okay, so the volume is flat. And when you say the volume is flat, I want to make sure I'm clear. You said when you're saying the actual volume, you're saying what's available to purchase, or do you mean all people in the market looking to do deals are flat? Like what exactly?
Yeah, that's transaction volume. So the total amount is $7.9 billion, which was off of approximately about insignificant. So essentially 7.9 billion in 2025. So it was like 7.93
Hmm.
in 2024. So it's just flat, you know. So I'm just
Well,
talking about volume. Hmm.
oh man, I don't want to be the guy who who always has to bring up interest rates. But that's one of the things that comes to mind. Also, like the um the economy, like where we are, overall market of um what the opportunities are. I just if I'm selling, then I know it's challenged and I'm not looking to sell. So I'll just hold on to my business. I won't retire yet. I'll just hold on so I can max out what I could potentially sell it for. I don't need the money is what you often hear when you're trying to do a deal, right? Like I don't need the money. I don't have to sell. I'm not in distress. So that could be some of it. Um, maybe there just aren't as many good deals to buy. There aren't that many good deals to buy. So it could be that as well. Um, I don't know, man. I'm really just ideating. I really don't know. Love to hear your thoughts on it.
Yeah. So, yeah. So when you hear like a stable market, right? Yeah. You know, I think that with the factors that are coming in, where you've got people, more people bidding on it, and for it to be flat instead of transaction volume up is interesting to me. Because typically you'd have an auction process, you typically is going to make prices go up. And the other thing that was alarming too is the quality of the businesses has also gone up, as mentioned. Median cash flows up 3%, but transaction volume, the overall transaction volume didn't increase. That to me is just interesting, and I think that's indicative of some things to come. Now, what exactly is going to come? We can dig into that here in a little bit, but I just think that certainly jumps out to me and is alarming that you didn't see uprise in terms of total transaction volume, total valuation. It's just 70.9 billion, even though the cash flow available went up, and so. Market's stable, valuations are rising, and businesses. So it's just the businesses that are selling are the best ones, I guess. But who's actually buying them, right? And has that changed? And so we pull back the curtain on that. The old buyer profile. You got a local owner operator, industry insider. Typically, they do an SBA loan. You got a handshake deal. Deal's done. But now you got a new buyer that's emerged, and there's four distinct archetypes that you're seeing that are coming in the market and competing for this. You've got your fund, your PE firms, your search funds. They're moving from the top end of the range and doing sub $5 million EBITDA deals. 44% of brokers report increased institutional activity. So they're coming down market, as you mentioned in a past episode, with institutional money coming to tertiary markets and real estate. We're seeing that same thing here in private equity. You got the ETA grad. These are the MBA students who are going off to college, and instead of pursuing a corporate career, they're now acquiring a boring business at a lower risk, that they see it lower risk than a startup. 5.7% of buyers here, and they're bringing data-driven management, financial discipline, and they've got a higher documentation standard than you typically would have with your old buyer profile. You got a serial buyer this is like 14.7% of the market. They already own businesses. They're building out a portfolio. And then that 44% of buyers are corporate professionals now that are looking and leaving traditional roles. More on them in a little bit. But I guess with pre bringing capital and professionalism into the lower market, is that actually bad? I mean, doesn't that kind of raise the floor for everyone and makes it brings a certain kind of standardization to the process, or does just Main Street just get priced out? What's your thoughts here?
I mean, you the the underlying answer is in the details of what you're insinuating. Uh, yeah, it's good for business. It does bring a level of sophistication, and it does improve opportunities in different markets that may not necessarily have been operated in the same capacity because they have a fund or a company that knows what to do, knows how to operate, like brings up um, the marketing efforts. They you know uh, introduce new software and technology, things like that. But the the downside of that is for the small time investors like me who are buying, especially smaller size businesses in that. You said lower to middle market is 25 mil or less. The people who are probably in the 1 to 10 million probably are seeing a lot more steep competition, or even people above 10 to 25 too, but uh, they're going to be challenged in terms of being able to get deal flow unless they have a moat, unless they have some type of advantage. If you're like going out there and you're just trying to do your first deal, it's going to take a while. You're going to have to turn over a lot of stones probably. Like if you're going against funds, because that's essentially what I've said in the other episode about what's going on in real estate right now, to your point.
So you think it's going to be bad for for the traditional buyer with with this private equity coming downstream?
I don't even want to necessarily say bad, but I don't know a time where more competition is good for someone on the opposite end. It might be good for the seller. It might be good for the clientele that, patronizes these businesses. But for someone trying to do a deal, like more competition, more offers on an asset you're trying to buy, I can't imagine that's a good thing.
Well, I think I hear you what you're saying, but I'd like to pose an opposing view to you here. And that view is that I think it brings some standardization to the process, though, right? Well, could you argue that it brings a standardized, rising tide lifts all boats? And what I mean by that is that, now that there's, more buyers and there's, brokers are going to have an understanding that when we come to the market, that private equity money's there. And if we want to get that private equity money, we've got to get the company in a certain order versus before when you just have these companies coming with all kinds of books, just crazy different paperwork. And, they may have one, company I was looking at a couple of weeks ago. Well, trying to, in conversations with now, they got cash statements. And in 1 year, they got an accrual statement in the middle of there. So it's just all over the place, right? And so with that, that professionalism that comes into the market, it kind of ushers in a wave of standardization that you probably didn't see before. So that could possibly, what you have with gap statements in public markets kind of ushers that into the lower middle market, where it now makes it easier to kind of evaluate companies. But now let's talk about, I guess kind of, I guess because quality businesses in desirable sectors, sellers, they now are choosing from multiple LOIs, right? And so that didn't happen 5 years ago. And here's my point. If the buyer pool professionalized faster than most sellers realized, then they now have to kind of catch up. And so I want to talk about and shift to the group that nobody expected to be here, and that's the corporate refugee. And this, I think, will resonate with a lot of our viewers, where 44% of prospective buyers are professionals leaving corporate roles. And we're just looking at the survey here. The motivation: 78% they want financial freedom, 72% say they want career control, but 28% are explicitly naming AI job displacement as a motivating factor. And that's not a niche feeling. It's a structural shift you see in how white collar workers are thinking about their futures. Got a quote here from one. He said, "Working for myself is my retirement plan." And I guess, what do you think that kind of says about the state of American business and their trust in corporate institutions today?
I mean, there's not a lot of trust. What we do see, what we have seen, if there's an opportunity to automate, they will automate. So, I mean, I, we don't know exactly. I know there have been a lot of talks of what could potentially happen, but we don't fully know yet, and we're still, I think, very early on in terms of what AI will do, what AI can do, like the actual capabilities, and if it will really do a lot more replacement or if it'll be a lot more augmentation. We don't really know yet, but I do think people are being vigilant and they're trying to get ahead of it. So um I could see someone, middle career or towards the later parts of their career, I'll just get ahead of it, right? I'll just take my ball and go home. I'll go do something else. And I don't necessarily have to worry about, um, you know, getting the pink slip because I'm established enough to where I can go pursue this. Now I have enough experience and cachet in whatever industry or sector that you are looking to purchase in. I mean, I think that's a smart way to go.
Think it's a smart way to go. I think you can, there's some validity in that. And the reason why I say that is because just if you examine the type of businesses that they're targeting, I mean, look, they're looking for established, cash flowing, recession resistant businesses. They don't want to build, they don't want something with high growth. They just want to buy something that works. And so I know you and I, through work, we've been through kind of, displacement at different jobs or different jobs. We've seen colleagues go through it. It's just kind of American life nowadays. You and people are probably going to go through a job displacement at some point through their career, where in the past that was more not than often. And so you got AI replacing copywriters, analysts, junior lawyers, they expect. And people who are watching that happen are starting to ask, what do I actually own? Right. And so uh, I guess you and I both agree it's kind of a rational hedge. But do you think some of that could possibly be people panic buying businesses they don't really know how to run and essentially taking on even more risk than what they did before?
Listen, you are making more than valid point. I said in a second ago, we really don't know yet, but I was saying it was a really good idea for someone that's toward the later end of their career because like, well, what's the real risk there? I mean, if you're planning to get out anyway, just, jumping out 5 to 7 years early. And then especially if you have like a working knowledge or some type of competitive edge for whatever business you're looking to buy, I think that makes sense. But I hope it's not people just panicking and then just going out with no ability to no operational excellence, no ability to figure out what your uh edge is, how you can actually compete. Yeah, you're going to be challenged. You're probably better off just staying an employee unless you have an actual solid plan like that. It's riddled with error, in my opinion.
Okay, agreed. And I guess most people think, they say commonly buying a business is a riskier path. I mean, you hear the different stats. Obviously, once an established business, it's past that 80% of businesses fail stats if it's been in existence for 3 years. Once it gets to 5 years, the chances of success dramatically increase, right? But I guess, if 20% of buyers are motivated by a displacement, maybe the riskier path is staying employed. I mean, just look, 65% of small businesses are now using some type of artificial intelligence in operations. Now, whether, that stat, can be inflated. I mean, because if you just Google search nowadays, you're essentially forced to use AI. It's in everything that you use. Even if you don't want to use it, it's there. But so now you've got PE firms and corporate refugees both hunting the same assets, right? And so something's got to give. And I guess just kind of look at what that possibly could look like in price volume, which is probably the part that most people want to kind of understand and unpack here in the show. So we talked a little bit about last show about this K shape that is just kind of dissolving in just the market in general. And the same principle, I think, happens here. I mean, if you look kind of across the table, I mean, you got in financial services, 38% volume. It's been a 40% price increase. Reason why, because they have recurring revenue, AI scalable, financial services is recession proof. Trades in HVAC, and it's high demand. There's not enough listings. Can't be automated. You're not going to see robots soon. You can't put an AI to go out and install an HVAC system. So that's going to be pretty safe for a while. Restaurants, they're down. Technology services are up 12%. New gen buyers see scalability in there. Manufacturing down 11%. That's due to tariffs uncertainty, capital intensive. And retail is flat, right? Or minus a 2% price on the listings if you're trying to purchase a retail business. And that's inflation hit, discretionary spending's down. So those are starting to feel pains right now. So essentially, I guess the kind of takeaway from that is the buyers want predictability right now. The plumbing company with 200 recurring service contracts, that's going to beat the hot new restaurant every time right now. And there's a quote from Adam Pratt, and he's saying there's just not enough listings for all the buyers and trades. And that's a supply problem, not a demand problem. And so you're going to see, if you're trying to get into those trades businesses, just expect a knife fight if you're going to try to get inside of those. But just kind of thoughts, I guess, right now. And we just want to kind of give some predictions here on what I think happens ultimately in the market. So just set up for a macro. As you know, volumes hit record highs. And we think that add-on, I guess, kind of the first thing I think is PEs, right? So you'll start to see the buy and build blitz start to proliferate a little bit more in Main Street businesses. And what I mean by that is that a lot of add-on acquisitions are expected to kind of pick up activity. They represent a majority of PE activity in 2026 will be add-on acquisitions. And so as firms seek synergies, expansion through geography, they're looking for cost efficiencies. They're going to do it through buy and build. And so you'll see that the PE firm that already owns a plumbing company in Ohio, and probably going to be bidding for that company in Tennessee, and then the one that's here in your local state. So that roll-up strategy is coming directly from those boring businesses too. So expect to see that going up. Another thing is everyone's expecting a buyer's market because of the silver tsunami, but more listings doesn't necessarily mean more good listings, right? The flood of supply could actually make quality assets more competitive, not less. And then Wealth Fair's favorite thing about interest rates, lower rates help everyone on paper, but in practice, they help people with the best lawyers and the biggest balance sheets first. And so the individual buyer gets to trickle down effect eventually, but the first people with the largest balance sheets are going to benefit from interest rates because they've been stockpiling for that opportunity. Lastly, another one I just want to say is that expect, and this is probably like a no-brainer, we expect that AI is going to change how businesses operate. It's changing how buyers will value them as well. So if the business doesn't have a clear AI story in 2026, you're probably going to be leaving money on the table. And I wouldn't say you're not going to get a bid, but I expect that your bid probably will be lower than some other businesses if you look at the comp. So be sure to pay attention to that.
What do you mean by that, the AI story? What do you mean by that?
Well, just that, you've got some type of path to using some AI automation that's showing increased efficiency in your business. So whether that's, you introduced a new chat bot that increases response time, so now you've got more lead flow that's coming in, or you found a way to cut, like I've seen some buyers on different podcasts talking about, they found ways to take that payroll that used to take, 6 hours to do and cut it down to 15 minutes because of the processes that they have with AI. So just things like that is what we kind of expect to see. But overall, I think the volatility will not just be risk, it'll create some pockets of opportunity. So be sure to pay attention for that, because uh, sellers are going to stop waiting, desperate buyers get an edge. You'll see both. So the question is, will you be positioned when that window opens up, or just still kind of filling out the paperwork? So we're going to kind of zoom and switch kind of cadences here, and also just take a little stab at the real estate investing market as well. So Will Fair, talk to us a little bit about what's going on as you've been seeing in 2025 and what you expect to see this year.
Well, this year, the at least as of right now, this recording, the excitement is around rates being cut. Um, Prime is a little bit less than, I think it's a little bit less than 6% right now, which people are very excited about. So what you're seeing is people, at least I feel like there's a little bit more interest. They're willing to dip their toe in the water a little bit because interest rates have come down a little bit. Now, the flip side, sometimes, I don't say all the time, but when rates go down, prices sometimes go up. So it's almost, you're trading one problem for another. And if you own property, then you're excited about the prices going up because that's appreciation for you. But if not, if you don't, or if you're looking to do a deal, you're definitely not looking to pay more. So just a lot of conversation in the real estate game of where rates will go and what the impact will be, and the overall economy. And um, I think we were talking about the market report and how I think the national average is saying like rents are either going to be flat or a little bit down for 2026. But that's just national average. There might be pockets where rents are doing really well. There are pockets that rents are really bad as well. So it's good to just be in tune with what's going on a national level. But at the end of the day, what's really going to drive your decisions is where you're looking to invest and just knowing your market.
Knowing your market. So, and by knowing your market, I'm guessing, but that old adage that all real estate is local. So you're saying knowing your local market will give you kind of a leg up on tons of things to do. Well, what are some things that you advise or that you personally have been doing to kind of get that edge on your local market? Is it just strictly going around and looking at houses, kicking doors? Are you talking to a lot of realtors? Reading certain publications? What's kind of the way to get that cooking and going?
Yeah, that's so good. We were talking about this off the pod one night, but what I'm doing, I'm in the middle of a deal right now, and this is a new market I'm entering. I've been looking, but I've never actually purchased in this particular market, and so this is very like a simple check. But I do have software where I try to figure out what the market rents are in this particular area, and I do all the due diligence before I buy. But another thing that I do is I check aggregator sites, apartment sites to just get a gist of what's being listed for rent. And then I'll go see how long the listings have been on, and then I'll see how many applications and how many contacts. And so, in my opinion, the way that I run my business or my analysis is if something has only been listed for rent for, let's say, 30 days or less, and there are a ton of contacts about it, that's probably priced appropriately. If you see something that's been listed 90 days and they've only gotten 6 contacts, that's probably not a good, it's probably not a good rental rate. So very anecdotal, but That's something that I always check when I'm in deal mode. So things like that, paying attention to the trends of where rents were trailing 12 months, where they were 24 months prior. That's something you can also check on. I mean, also you can utilize your LLMs, like your chat GPTs of the world and all that stuff to aggregate some of that information for you. But um, that's just that's what I'm seeing and that's what I'm doing in terms of like deal flow right now. Just making sure the rents are solid, and then I mean, some people are also shifting towards. I don't know if we've ever talked about this on the pod much, but Section 8 investing too, to feel like they're getting some type of guaranteed, quote unquote, guaranteed rent coming in, especially during this time with the volatility of the economy.
Understood. Now, you mentioned something interesting when you talked about seeing a property that's been sitting for 90 days, but only had six contacts. Okay.
Right. Right.
Question about that. Now, you mentioned that would give you pause for alarm. Just curious if that, could be due to it just not being able to generate the most valuable currency in any market, which is attention. Could that be what's driving the problem behind the listing, or what's kind of some things that got you kind of got scared?
Yeah, that's more than fair. I mean, you see that a lot with people looking to sell properties a lot of the time. So what you're hinting toward is, well, maybe it's not the pricing. Maybe it could be the description is not detailed enough, or maybe it's just written in a way that isn't enticing, or maybe the photos are blurry and you can't get a good gist of the property, or the property itself is on an undesirable street, or is right next to something people don't want to live next to, right? um very, very possible. Good call out. I will say I don't drill into all of those because those aren't necessarily properties I'm usually looking to invest. It's just more so I use it as a validation of, okay, am I the way that I'm thinking about my pricing strategy for rent, is it in line with what I'm thinking, or do I need to go back and come up with a new number in terms of what I think I can actually rent it for? Um, that's really more so what I use those sites for, to see what's listed for rent and what's been listed for rent, as well as the software that I use.
Okay. And so based on your views, I mean, you've seen how 2025 went, you got a direction for 2026. Which strategy would you feel is probably going to be the one that benefits most in 2026? And by that, I mean, would you say generating cash flow, flipping properties to build wealth, or, optimizing a hybrid between two? Which one do you think, or is it going to be a compromise between those?
Man, that's an awesome question. You're not gonna like my answer. um, so you know how the running joke on social media is, when something happens that's out of the norm, people say, "Oh, it's a recession indicator." It's like always something is a recession indicator or whatever. For me, the indicator is not a recession indicator, but indicator that real estate is in trouble is all of the YouTubers that always talk about real estate. Everyone's posting, "Oh, real estate's dead. Oh, the bird is dead. Oh, flipping doesn't work. Oh, go do something else. Real estate doesn't work anymore." It's just like either that's going to be like the greatest buying opportunity, or they're just not able to figure out their strategy is not currently working with this market. So I would say if you have a strategy that's working, keep doing more of that. And if you have a strategy that's not working, pause and don't keep trying to force your strategy. That's how you get burned. So for me, my particular market, like we talked about in the other pod, there's a lot more competition, and I'm just not able to find deals as easily as I have been in the past. And so naturally, instead of me forcing it, although I know this market, I'm just gonna wait until it cools off. So I found another market that works right now, and so I'll keep going to that market until that one doesn't work, and then I'll like flip to another So I'm keeping my strategy. I'm just finding a different market. So that's an option too. It's just like if you have a strategy that works and you know it well, then you probably can apply it to a different market, versus keep trying to do the same strategy in the same market and it's no longer working in that particular market.
Understand. And you said something that struck me here, where you were talking about your particular strategy and how you are going into a market, but then when you feel that market is overheated, you move to another market. So it sounds to me you are guarding for risk of an overheated hot market. I guess kind of expand on that for me. Wouldn't you want a hot market? What's the dangers in that?
I mean, the danger is, and I've already been burned, so I can kind of talk about it. But if the market's too hot and your strategy is not working, then your margin, your cash flow, you probably aren't seeing the same cash flow. You probably aren't able to buy at the same price. Your deal doesn't work, meaning you're not going to make positive cash flow on it. You're going to be paying more for the same deals, and it's a lot more competition. So at some point, yeah, you win the deal, but you actually lost money, and that's not a win at the end of the day. So be okay with either sitting on the sidelines, continuing to save, get your war chest ready, so when there is opportunity, you can jump on it, like you were saying earlier, or be okay with learning about another market, because once you have a strategy stays the same. Only thing that changes is the market itself. And then sometimes you'll just have to potentially change or augment your strategy, which is also helpful. So I don't know a real estate investor is just good at every single piece of, I'm really good at wholesale, I'm really good at flipping, I'm really good at sub two, I'm really good at long-term rentals, I'm really good at Airbnb, but it does help to be able to have at least one or two different capabilities in your tool bag, just because you can change and shift with, like, be a little bit more dynamic with what's going on.
Okay. And you talk about flexibility, being dynamic with what's going on, and having one or two tools in a toolbox. And I guess that toolbox is built around your thesis, as we've talked before. And when it comes to investing, I know we talked before, and if you paid attention to the early episodes of Point of No Returns, we kind of went into building out the thesis and what our respective thesis is. Not really going to dig into that part, but I guess overall on that thesis, in terms of like progress for it, you feel like you're able to make progress in this market, or you feel like you're falling behind, or you feel like you could be able to catch up? What's your thoughts on that?
When you say falling behind, what exactly do you mean? Like with people that are growing their portfolios? Like, what do you mean?
Well, for your personal thesis, like, yeah, you set out a thesis, I'm going to
Oh, I
have
see.
X amount of
I got you.
dollars portfolio, and I'm going to be able to move in and out of these markets. So, and this is why I think real estate is the path for me to accomplish this goal. And so, overall, I guess with things going, how are you feeling overall, compared to, I guess, kind of your benchmark where you are in your thesis at this point? Do you feel like you're where you need to be? Do you feel like the market's allowing you to keep on track, and there's a lot of opportunity for you to catch back up? Or you feel like you're behind? You feel like you're ahead? Just kind of what's your thoughts
Yeah.
overall?
Oh man, that's so good. Well, I'm only like calling myself a quote unquote investor for, this will be going into the sixth summer. So I still feel like I'm really early on into this. But funny enough, when I first started out, you don't know what you don't know what you don't know. So at the time, 2020, I mean, prime was, it was sub 5%. Like you were able to get investment properties under 5%. um, you don't realize how good it is until you don't have it anymore. But I was early on in this, so yeah, you could just print money with those deals. Now, 6, 7%, and then sometimes higher than 7%. Yeah, it's tough sledding. Um, and it's still, I mean, in the grand scheme of things, 7 is just not an outrageous rate, but it's just for people that remember when it was 4.5 and 4.8 and 5%. Yeah, you kind of reminisce on, wish it was like that. Um, but Yeah, I mean, the past couple years have been a little bit more difficult. But like I said, there's still always opportunity. It's just, are you willing to change what you've been doing? If you're looking to do the same exact thing in the same exact market and it's not working right now, you're going to be in a tough spot because we don't know how long it's going to not work. I mean, everything's cyclical. So I do understand that, but we don't know how long the cycle is. Like it could be 6 months, it could be 2 years, it could be 5 years. We don't know. Um, so that's why I'm just like, okay, I'm not going to limit myself to just one market. Maybe if and we can talk about it in another pod, maybe it's worth a deep dive, but I've started to like reimagine what I would like for my entire portfolio to look like. So I'm a little bit more insulated and have some level of risk mitigation in my portfolio as well.
Understood. Understood. And I guess we got to check in and see how that keeps going as time goes on. But folks, we've come up on time here. This is another episode of Point of More Returns. We ask you to hit that subscribe button if you haven't already. Thanks for joining us, and we look forward to seeing you again on the next episode.